The US-China tariff war, a deeper game. The ongoing US-China tariff war appears to have brought things back to square one, but beneath the surface lies a far more intricate struggle. This contest between the US and China is destined for a clear victor. Only when one side concedes can global order truly begin to normalize. While the outcome of this battle won't necessarily determine who becomes the world's sole superpower, it's undoubtedly a crucial indicator for the broader US-China rivalry. We're currently in a phase where both sides are testing each other's endurance. So, when will it all end? Under normal circumstances, this is a war of attrition, with each nation focusing on boosting revenue and cutting expenses, waiting for the other to collapse first. China's strategy relies on industrial upgrading and wealth redistribution reform. The US, on the other hand, is leaning on internal layoffs and external financial exploitation. If this continues, a winner will eventually emerge, but the process could be incredibly long. Why? Both countries are vast and have deep reserves, enabling them to withstand prolonged attrition. We could be talking decades, perhaps even 80 or 90 years, and that wouldn't be an exaggeration. However, a global economic crisis could drastically accelerate this timeline. For China, in particular, such a crisis might offer the fastest and least costly path to victory in this tariff and trade war. How an economic crisis could accelerate China's victory? Let's examine this from the perspectives of both the US and China. The United States, on the brink of financial collapse. If a global economic crisis were to erupt now, it would most likely originate in the US. After all, globally speaking, only the US possesses the power to trigger an economic crisis and drag the rest of the world down with it. Moreover, the current financial state of the US is precariously close to a financial implosion. Consider the upcoming months, with trillions of dollars in new and refinanced debt every month. That alone is enough to challenge the US government. If they can't navigate this, a financial meltdown is imminent. Even if they somehow manage to scrape by, the underlying issues with US debt, stocks, and the dollar will remain unresolved, only worsening over time. A full-blown implosion remains highly probable. A financial implosion, leading to a global economic crisis, would inflict its greatest damage on the US not through capital outflow or destruction, but through the depreciation of the dollar's value. The US has become a financialized nation, largely stripped of its manufacturing capabilities. Why could it still be the world's largest consumer and have the world clamoring to sell it goods? Because of the dollar. The dollar remains the global reserve currency, the only widely accepted money for international trade. Thus, the US effectively treats the dollar as a commodity, exchanging it for the fruits of others' labor. But the dollar's unique value is underpinned by the US's unique strength and status. With China's rise, the US no longer holds that exclusive strength and status in many areas. The dollar's value inherently carries a risk of depreciation, and this depreciation becomes more pronounced as the gap in comprehensive strength between the US and China narrows. If the conflict were limited to a tariff war, countries unable to sell goods to the US and obtain dollars would gradually explore other currencies like the euro or RMB. This would indeed shrink the dollar's international trade usage and erode its value, but the process would be painstakingly slow and prone to reversals. However, a financial implosion is different. The US's technological and military hegemonies are already being severely challenged by China. Its financial hegemony is arguably its strongest remaining one. If this financial hegemony also collapses, the last and most powerful pillar supporting the dollar's value would severely tilt. The result? Even if the dollar doesn't completely collapse, its credit would be severely impaired, and a value crash would be unavoidable. The US currently relies primarily on the dollar as a commodity to exchange for goods globally, and then uses the dollar to manipulate and extract wealth from global financial markets. If the dollar's value depreciates and its application scope and scenarios drastically shrink, the US would acquire fewer goods and its ability to extract wealth globally would significantly diminish. In essence, this means soaring internal inflation in the US and a substantial decline in its ability to extract global wealth. The US administration's greatest fear is rampant inflation, a financial collapse caused by the dollar being abandoned globally and flowing back domestically would lead to far greater inflation than any price hikes from Chinese tariffs. As for the diminished ability to extract global wealth, That's even more critical. The US currently faces numerous deficits and is operating beyond its means. Its entire system is barely sustainable. If its ability to extract wealth declines further, this would be catastrophic for the US. Therefore, if an economic crisis erupts, the US would face to pounce. 1. Actively end the purely attritional tariff war, as it would no longer have the capital for such a conflict. It would also have to proactively cede various global interests to China in exchange for support from the East, allowing both sides to engage in quantitative easing and debt restructuring together. 2. Unleash a big move. If it wins, the empire continues to flourish. If it loses, it's total destruction. But for most countries, even winning such a conflict might not be meaningful and could instead lead them into a quagmire. As for China, we have long anticipated this. In recent years, we've been rapidly building up our military and showcasing advanced weaponry. Our production capacity and military technology have surpassed the US. Engaging China in such a conflict would undoubtedly lead to the demise of the US, regardless of China's eventual state. That's the situation for the US, China, poised for opportunity. China has prepared far more comprehensively than the US. Our strategy for dealing with the tariff and trade war is clear. Domestically, focus on industrial upgrading and domestic substitution, led by new energy and semiconductors, to keep wealth within the country. We also need to earn money overseas. Additionally, measures like reducing forced overtime and promoting wealth redistribution through wage increases are crucial for stabilizing the economic and employment base. Externally, seize the opportunity presented by US bullying to advance yuan internationalization. This is indeed the correct path, but such correct paths often yield slow results. The money saved through domestic substitution has its limits, and earning money overseas isn't easy. Ordinary countries outside the US and its Western allies are already struggling financially and have been further impacted by the US trade war, which constricted global liquidity. They don't have endless markets to absorb Chinese manufacturing. As for yuan internationalization, it's a slow process due to historical inertia. As long as the US doesn't face major internal disruptions, even if its use of the dollar to extort the world is disliked, it's unrealistic to expect countries to quickly abandon the dollar and embrace the RMB, risking US retaliation and financial losses. This implies that even if China ultimately prevails, the process will involve several years of hardship. However, if a US financial implosion triggers an economic crisis, the situation could change dramatically. A crisis is both a danger and an opportunity. China has long been preparing for such a crisis. We won't even mention the solid foundations in industrial upgrading and technological innovation. Our policy reserves have also been abundant, with most still unused. Even cyclical assets like the stock and property markets have been firmly suppressed at low levels. Therefore, once a crisis truly materializes, we have the confidence and cards to play. When the crisis first erupts, the entire world will likely be dragged down by the US, and China will probably not be able to avoid it entirely. But soon, we will be able to play all our accumulated cards. If our accumulated reserves aren't sufficient to counter the impact of the economic crisis during this process, then there's nothing to say. We'll all sink together, and perhaps even have to prepare for war like other countries, as there would be no other solution besides ultimate measures. However, if we succeed in this round, the result will be not only pulling ourselves out of the mire, but also becoming the engine that kickstarts a new round of global economic cycles. If that happens, we will swiftly defeat the US, not just in the tariff war, but across the board. This might sound abstract, so let me elaborate. Economic crisis, similarities and differences to 1929. What are the similarities and differences between this potential economic crisis and the one 100 years ago? Similarities. Both involve overproduction and the rise of global trade barriers. Differences. The causes of overproduction and the role of finance. Let's start with overproduction. The US triggered economic crisis and subsequent Great Depression 100 years ago were preceded by the Roaring Twenties. This prosperity was built on the Second Industrial Revolution's breakout and widespread adoption, leading to a leap in productivity. The US generated a massive amount of goods, but the distribution mechanism failed to keep up. Wealth flowed continuously into the hands of American capitalists through commodity transactions, while other countries and ordinary citizens within the US received insufficient returns. This was fine in the short term, but over time, people ran out of money, and consumption couldn't keep pace with production, leading to overproduction. Consequently, as the Great Depression began, countries worldwide erected trade barriers. Within the US, President Roosevelt implemented heavy taxes on capital to redistribute wealth to the populace. In essence, it was a backlash after the wealth had been sucked dry by advanced American productive forces. Is our current situation the same? On the surface, overproduction and trade barriers resemble the past. However, there's a crucial difference. The entities truly extracting global wealth are not the producers, i.e., industrial capital. A significant portion of the wealth in this process has been siphoned off by financial capital, acting as intermediaries. Moreover, industrial capital and financial capital belong to different countries, China and the US, respectively. This dictates that this time we have a perfect solution for the economic crisis: remove the financial blood-sucking machine and distribute the blood it extracted to global consumers. The solution: bypassing the US and the dollar. What does this mean? Simply put, it means playing without the US and without the dollar. As mentioned earlier, the US is the world's largest consumer market because it treats the dollar as a commodity, directly exchanging greenbacks for the fruits of others' labor. These greenbacks flow overseas, becoming the primary settlement currency and reserve currency for international trade. The US then uses the dollar to create dollar tides, repeatedly harvesting wealth from overseas nations. What are the consequences of this? A significant portion of the wealth diligently created by people worldwide has been plundered by the US, especially by its financial capital, through this green paper. This might be tolerable once or twice, but over the long term, it becomes a continuous drain. When the dividends of the third technological revolution are exhausted, and humanity can no longer create enough new wealth to satisfy capital's greed, capital, driven by its inherent desire for power, can only begin to erode existing wealth. A reduction in existing wealth inevitably leads to consumption depletion, which in turn leads to overproduction, and the game can no longer be sustained. This is the fundamental reason for this round of economic crisis. And this precisely is China's breaking point. If this economic crisis were like the one 100 years ago, primarily caused by industrial capital accumulating all the money, then if China wanted to avoid war, it would have to force industrial capital to release money and stimulate consumption. This would mean internal reforms. However, since it's the Jewish financial capital in the US that has largely profited, the solution is to force them to release the money. If they do, governments and working people worldwide will have money, and consumption will recover. As consumption recovers, China's overproduction problem will be resolved, and industry will have funds for further R&D and breakthroughs, fueling the fourth technological revolution and breaking humanity's wealth ceiling. Therefore, dismantling the financial intermediary aligns with China's interests, the interests of other countries, the interests of working people worldwide, and the common interests of human civilization's development. How to force financial capital to release wealth? The question, then, is how to force that American Jewish financial capital to release its accumulated wealth. There are many ways, but it boils down to one: depress the value of the dollar and undermine its status as the world's reserve currency. Financial capital leverages the dollar in its global power plays. Every point the dollar's value drops, and every instance its world currency status is weakened, reduces financial capital's ability to tax global trade by that same amount. Conversely, the purchasing power available to buy Chinese goods increases by that same amount. However, as mentioned, under normal circumstances, despite the dollar's irreversible trend of value depreciation due to historical inertia and US hegemonic influence, the speed would be very slow. But an economic crisis changes everything. When a crisis erupts, the dollar's value naturally plummets. The dollar, after all, is merely a currency, a symbol of wealth, not true wealth itself. When a wealth symbol's value is damaged, two scenarios can occur. 1. Currency credit collapses and value depreciates. International trade becomes inefficient. This translates to severe overproduction on the production side, leading to situations like capitalists dumping milk. If currency credit cannot be restored for a long time, and no other sufficiently credible currency emerges as an alternative, then this impact becomes long-term. Capitalists cannot indefinitely produce milk only to pour it away. Seeing this, they would close factories. In this case, the dollar's value depreciation becomes a concrete loss, and the consequence is a global Great Depression. After the dollar's value depreciates, if there is another sufficiently credible currency to replace it, allowing international trade to continue efficiently, then the dollar's value depreciation is reflected only in the loss of wealth in dollar-denominated assets. Assets denominated in other currencies would not be harmed. In fact, assets denominated in the alternative currency would appreciate significantly. This is because international trade can continue after the currency switch. The real wealth of humanity outside the dollar's sphere would not depreciate. Figuratively speaking, capitalists in this part of the world can still produce and sell milk. Only the currency they receive changes from dollars to RMB, euros, or even gold and commodities. As long as goods can be sold for money, capitalists won't close factories. Production can continue, and wealth won't be lost. This dollar-independent part of the world would naturally avoid a Great Depression and might even enter a new period of prosperity. This is because by not using the dollar, they are no longer subject to financial capital's exploitation. As long as the issuer of the alternative currency doesn't emulate the Jewish financial capitalists' practice of draining wealth, the money saved will become the consumption power of various governments and populations, flowing back into global trade. And this newfound consumption power, flowing into the hands of governments and people worldwide, will become the driving force for China to revive its economy and kickstart a new global economic cycle. Previously, this money was held by financial capital, not only preventing its entry into the global production and consumption cycle, but also becoming a tool to constrain China in the form of the US, the world's largest consumer market. If you are unhappy, the US would impose tariffs, eliminating your trade surplus and hurting your economy. However, once an economic crisis causes the dollar's value to depreciate and American financial capital's global leverage weakens, the oil they can no longer extract from the global economy will become incremental wealth for various governments and people. While this wealth was always theirs, it was previously siphoned off by the Americans through the dollar. With this incremental wealth, countries and people will naturally purchase goods, and most of the world's goods are produced in China. Our economic problems will be resolved. At the same time, because this wealth is no longer concentrated in the US and no longer primarily in dollar form, China will no longer be held hostage by the US. To put it bluntly, we will no longer be forced to play the game of exchanging goods for green paper with the US, while simultaneously being bullied by the absurd logic of we won't exchange paper for your goods anymore. As for the current US administration, by then, it would be utterly insignificant. They can go to hell. Conclusion: China's moment to reshape the global order. This is my logic for why China's victory over the current US administration might be accelerated by a global economic crisis. It's not to say that a crisis is absolutely necessary for China to defeat the US, but rather that it could significantly shorten the timeframe. Of course, this is just one possibility. If, after an economic crisis erupts, China's prepared measures fail to effectively counterbalance and reverse the impact, then there's nothing to say. Everyone will sink together, perhaps even preparing for a final showdown. Furthermore, if China performs unexpectedly poorly, then despite global disgust with the dollar, without a suitable alternative, countries might still choose to cut their losses and work together to rebuild dollar credibility and maintain international trade. These possibilities also exist. However, I believe the first two scenarios are unlikely. China's preparations over these years haven't been in vain, and its policy directions have been clear enough. From current indications, a US financial implosion appears increasingly imminent, and China's strategic planning of accumulating strength and waiting for the opportune moment is becoming clearer. In this situation, I firmly believe that a well-prepared China will have the sufficient capability to play a magnificent trump card at the peak of this unprecedented period of global change. After all, we have been preparing for so many years, waiting for this very day. The eruption of an economic crisis will be the day China defies fate and reshapes the global order. We have sacrificed so much and prepared for so long. Both by sentiment and by reason, Our nation will not let this early seized historical opportunity slip through its fingers.